Subscribe now and press the bell icon. Never miss an update.
Hi guys, this video will be about investment at cost, deferred consideration. When calculating goodwill, we must know what the value of the investment at cost is. This is representing the investment made in the subsidiary. Now, investments could be immediate, deferred, or contingent. This video talks about deferred consideration. Deferred consideration is where the parent has promised to pay the subsidiary some cash at some point in the future. So the consideration is deferred, postponed. So if we have such deferred consideration in the future, we must discount that future cash to the present value. And the present value of the amount promised is the investment at cost. And to find the present value of future cash, we use the formula. Cash divided by 1 plus the interest rate to the power of n. R is the interest rate and n is the number of years in which you will defer for. Or another way to calculate the present value is where you take the cash flow, the amount that you've promised, and you multiply it by the present value factor. The present value of the future cash is what is used for the investment at cost in the goodwill calculation. But then because you found the present value of something, you will have to unwind the discount. Because we discounted it, we need to release the discount. This is called unwinding. And unwinding is where we charge interest as finance cost. So therefore the finance cost is the present value you calculated multiplied by the interest rate. This interest rate is going to be deducted from the parent's retained earnings, which is another key working. Now the deferred consideration plus the interest, this is going to be shown on the face of the balance sheet under current liabilities. So let's have a go at this example. Panama acquired 75% of Suarez's 80 million ordinary shares on the 1st of April 17. Panama paid an immediate $3.50 per share in cash and agreed to pay a further amount of 108 million on the 1st of April 18. So that means Panama has promised to pay an extra cash a year later. Panama's cost of capital is 8% per annum. Assume the year end is March 31st and the balance sheet is March 14. What is the total cost of investment? Well, the cost of investment is considered of two things here, the immediate cash and the deferred cash. The immediate cash is simply $3.50 of the number of shares required. Panama bought 75% of Suarez's 80 million shares. So 75% of 80 million, that means the parent took 60 million of the subsidiary shares. And the cash paid on that, $3.50 times 60 million, that's 210 million. But the deferred cash on this, you need to discount. The parent promised $108 million in cash at 1 year in the future, but you need to discount that. And how we discount that, guys? We need to apply the cost of capital of 8%. So we discount it at cash, 108, divided by 1 plus the interest rate, which is 1.08, raised to the power of 1, which represents the number of years that we defer. So if you type that on the calculator, the present value of 108 million a year later is 100 million. So therefore, the total consideration is the cash that we paid today plus the present value of the cash we'll pay next year. That is 310 million. So the 310 million is going to be used for the goodwill working. But the additional thing of the unwinding of that present value, how do we unwind it? The finance cost is simply the present value 100 million times the cost of capital 8%, which is 8 million. This is going to be deducted from the parent's retained earnings in the consolidated reserves working. So when you're preparing the consolidated balance sheet, under current liabilities, you will see a line for deferred consideration, where you take the present value 100 and you add the finance cost of 8. So you will put 108 million on the face of the balance sheet. And that's how you calculate deferred consideration.